Hello and welcome back to another video. Today I'm going to be explaining surety bonds. Now by the end of this video you're going to understand everything you need to know about them, as well as all the benefits and disadvantages, so make sure you watch all the way to the end so you don't miss any important details. So to start with, what is it? Surety bonds are a type of financial agreement that involves three parties. The first party is the principal, who is the primary party that will perform the contractual obligation. The second party is the obligee, who is the recipient of an obligation. The third party is the surety, who assures the obligee that the principal can perform the task. In other words, the surety provides a guarantee to the obligee that the principal will fulfill their obligations. If the principal fails to meet their obligation, the surety will fulfill the contract or pay a penalty to the obligee. This makes a surety bond a form of risk management for the obligee. They are commonly used in the construction industry, where contractors are often required to provide a surety bond to agree that they will complete a project as per the terms of the contract. So how does it actually work? It works as a legally binding contract that involves three parties: the principal, the obligee and the surety. The principal is the party who will perform the contractual obligation, the obligee is the party who is the recipient of an obligation, and the surety is the party who assures the obligee that the principal can perform the task. The surety provides a financial guarantee to the obligee that the principal will fulfill their obligations. If the principal fails to deliver on the terms of the contract entered into with the obligee, then the obligee has the right to file a claim against the bond to recover any damages or losses incurred. If the claim is valid, the surety company will pay reparations that cannot exceed the bond amount. The underwriters will then expect the principal to reimburse them for any claims paid. So what are the benefits? To start with, risk mitigation and protection. Surety bonds offer significant protection by mitigating risk. They shield the obligee from potential losses if the principal fails to meet contractual obligations. There's also enhanced credibility and trust. A surety bond enhances the credibility of the principal and can increase levels of trust among consumers. It can also lead to cost savings. This can reduce interest rates for borrowers and help lower rates for some services because it helps build a good credit rating. You can also ensure your cash stays in the business. A bank will usually require some form of collateral when issuing guarantees, typically in the form of cash or by reducing banking facilities or overdrafts. In the case of a surety bond, an alternative form of security is taken via a deed of counter-indemnity. This allows the company the opportunity to re-inject the cash into the business. So what are the disadvantages? To start with, the cost. Surety bonds can be expensive, especially if not thoroughly researched. The cost of a surety bond can vary widely depending on the risk associated with the bond, the financial health of the principal, and the surety company's underwriting guidelines. There's also strict terms and conditions. Surety bonds often come with strict terms and conditions that must be adhered to. Failure to comply with these terms can result in claims against the bond, which can be costly for the principal. There's also a significant upfront payment. Some surety bonds require a significant upfront payment, and this can potentially delay your project for months. And finally, there's the potential for claims. If a claim is made against a surety bond, the principal is ultimately responsible for repaying the surety company for any money it pays out on claim. This can create a financial burden for the principal. So this has been my video fully explaining surety bonds. Hopefully now that you've watched it, you understand everything you need to know, and hopefully this video will assist you in the future. I also hope you found this video helpful, and if you did, please comment down below for more content like this. Thanks for watching.